Are you ready to explore a resilient and recovering commercial real estate market that's forecasted for investment growth? Welcome to the Commercial Real Estate Insights Podcast. I'm your host, Steve Hamoen. Let's get right to it. In the face of ongoing challenges like tariffs and geopolitical conflicts, the commercial real estate market continues its robust recovery. According to CBRE, the world's largest commercial real estate services and investment firm, we're set to see a 10% increase in investment activity this year. Notably, office property sales are expected to climb nearly 20%. This optimistic outlook comes despite the complexities of erratic U.S. trade policies and the geopolitical uncertainties that have tempered both business and consumer confidence. The office market in particular is showing signs of resilience. CBRE's global head of research, Henry Chin, highlights that rental growth is projected in 46 out of the 64 U.S. office markets tracked. And while the office vacancy rate remains high, the market is clearing out unwanted space through conversions and demolitions. By year-end, 23.3 million square feet of office space is expected to be repurposed into apartments, hotels, and more. Retail real estate, surprisingly, has shown strong performance. Despite policy uncertainties, the retail segment has maintained tight availability in prime locations, a result of a decade of limited construction. High-quality spaces are in demand, with power centers and value-oriented retailers expanding steadily. This trend suggests a strong preference for high-traffic, open-air centers in populated areas. In the multifamily sector, rental growth might have bottomed out, but the cost of buying properties remains higher than renting. This is keeping both buyers and sellers on the sidelines. Regions like the Midwest and Pacific Northwest are leading this sector's growth, with rental prices slightly down from last year. Meanwhile, industrial spaces continue to attract demand from logistics providers and e-commerce companies, although economic uncertainties and tariffs might slow construction completions. So, what does this mean for regions like Kitchener-Waterloo, London, and Cambridge in Ontario? These areas may see similar trends, especially in multifamily and industrial spaces, given their growing urban populations and proximity to major transportation hubs. Cross-border, the U.S. market's resilience offers insights that can be relevant to Canadian investors looking to navigate local uncertainties while tapping into broader North American opportunities. In the wake of significant challenges, including the 2008 financial crisis, the 2020 pandemic, and the tragic 2025 Park Avenue shooting, major asset managers like Blackstone have emerged as architects of resilience in the commercial real estate sector. Blackstone's efforts to adapt security and operational strategies are aimed at restoring confidence in prime office assets. Understanding these strategies is crucial for investors seeking long-term value in a sector that remains pivotal to global capital markets. Blackstone has reimagined security from a reactive to a proactive defense mechanism. The 2025 Park Avenue shooting exposed vulnerabilities even in the most fortified urban spaces. In response, Blackstone has prioritized a multi-layered, technology-driven framework. AI-driven surveillance systems now flag anomalies such as unregistered individuals or erratic behavior, which has been implemented at the Trocadero complex in Paris. Physical barriers and access controls have been enhanced with secure elevators and biometric verification. Collaboration with firms like Kroll and Allied Universal ensures rapid coordination during emergencies, transforming security from a cost center into a strategic asset. Operational strategies at Blackstone reflect a focus on prime office assets, highlighting strong tenant retention, energy efficiency, and strategic urban locations. The firm has secured a €500 million loan for the Trocadero office complex in Paris, signaling confidence in high-quality urban real estate. This debt-fueled acquisition approach allows Blackstone to scale quickly while maintaining liquidity. Additionally, office spaces are being converted into mixed-use developments to cater to hybrid work demands, and Blackstone is diversifying geographically into high-growth cities like Stockholm and Singapore. Technology plays a pivotal role in Blackstone's strategy, redefining office asset management. The integration of smart building systems optimizes energy use, reducing costs significantly. Sustainability certifications like LEED and BREEAM are now standard, attracting ESG-focused tenants. Tenant experience platforms enhance satisfaction and retention by allowing easy booking of meeting rooms and tracking of maintenance requests. As of 2025, 70% of Fortune 500 companies prioritize ESG criteria in office leases, a metric that Blackstone's portfolio is well positioned to meet. For investors, Blackstone's strategies highlight a sector in transition. The firm's focus on prime assets, coupled with technological and security upgrades, creates a flywheel effect of higher tenant retention, lower operational costs, and premium rental yields. By avoiding secondary markets and prioritizing high-occupancy properties, Blackstone minimizes vacancy risks. Debt financing and tech-driven efficiency allow rapid expansion without sacrificing margins. Furthermore, governments incentivizing green office conversions through tax breaks align with Blackstone's ESG-aligned portfolio, offering a boon for future growth. The retail real estate sector in 2025 is navigating a paradox. While electronic commerce continues to erode traditional brick-and-mortar models, physical retail assets are paradoxically gaining value in select markets. JC. Penney's recent $947 million sale of 119 stores to Onyx Partners Limited offers a microcosm of this transformation and a blueprint for how long-term investors should rethink their strategies in an era of retail distress and reinvention. JC. Penney's decision to offload 119 properties, part of a broader Chapter 11 restructuring, highlights the accelerating shift in retail real estate. The sale, facilitated by the Copper Property CTL Pass-Through Trust, underscores how legacy retailers are repurposing their physical footprints to meet evolving consumer demands. These stores, leased under a triple net structure, were sold for an average of $8 million per property, significantly below the $14.75 million paid for high-traffic locations like the Fashion Valley Mall store. The lower valuation reflects both the urgency to meet liquidation deadlines and the broader devaluation of traditional retail assets. For long-term investors, the transaction signals a critical trend: the reclassification of mall real estate from retail-only to flexible-use assets. The 15.86 million square feet of sold space, spread across 35 states, could be repurposed into mixed-use developments, logistics hubs, or experiential retail complexes. This mirrors the broader industry pivot toward adaptive reuse, where underperforming retail properties are rebranded as community hubs or industrial assets. For decades, mall valuations were tied to the presence of anchor tenants like J.C. Penney, Sears, or Macy's. These retailers not only drove foot traffic, but also served as financial ballasts for mall operators. However, the 2025 Placer.ai white paper reveals a seismic shift. The rise of experiential anchors, such as Scheels, Barnes & Noble, and high-volume restaurants like In-N-Out. These tenants generate traffic through unique experiences rather than traditional retail, reducing dependency on single large anchors. The implications for real estate valuations are profound. When a traditional anchor exits, it often triggers a cascade of co-tenancy clause violations, leading to inline tenant vacancies and net operating income declines. In contrast, experiential anchors create a more resilient tenant mix. For example, a fitness center or a pop-up art exhibit can draw traffic at different times of the day, allowing operators to stagger peak hours and optimize staffing. Long-term commercial real estate investors are adapting to these shifts through three key strategies: adaptive reuse and mixed-use developments, diversified tenant mix, and tech-driven efficiency. Investors are repurposing mall properties into residential, office, or logistics spaces. For instance, the Gateway Center in Brooklyn, once a retail anchor, is being redeveloped into a mixed-use complex. This strategy reduces exposure to retail-specific risks while capitalizing on the scarcity of prime urban land. Modern malls are prioritizing a blend of necessity retailers, experiential tenants, and service providers. This diversification mitigates the risk of a single tenant's exit. For example, a mall with a grocery store anchor is less vulnerable to foot traffic loss than one reliant on a department store. PropTech tools are optimizing operations and tenant retention. Artificial intelligence-driven foot traffic analytics, smart leasing platforms, and energy-efficient retrofits are reducing costs and enhancing tenant experiences. These innovations are critical for competing with electronic commerce, which offers convenience at the expense of physical interaction. The J.C. Penney sale must be viewed through the lens of broader retail real estate dynamics. By 2025, United States retail vacancies have plummeted to 1.8%, the lowest since the 1980s, while new development remains constrained. This scarcity has driven demand for existing assets, particularly in Sunbelt markets like Dallas, Tampa, and Phoenix. Investors are capitalizing on this trend by targeting undervalued mall properties in these regions for repositioning. Real estate investment trusts, such as Simon Property Group and Prologis, are well positioned to benefit. Simon's focus on adaptive reuse and Prologis's logistics expertise align with the sector's pivot toward flexible, high-demand assets. Meanwhile, private equity firms managing liquidation trusts, like Hilco Global, are profiting from advisory fees tied to asset turnover. For long-term investors, the key takeaway is clear. Diversify exposure to retail real estate by prioritizing flexibility over traditional anchors. Here's how to approach the market. Target Sunbelt markets, leverage real estate investment trusts, invest in PropTech, and avoid legacy retail equity. Properties in high-growth regions with low vacancy rates, like Austin and Houston, offer the best returns. These areas benefit from population growth and limited supply. Real estate investment trusts, with a focus on adaptive reuse and logistics, are ideal for passive exposure to the sector's transformation. Startups developing artificial intelligence-driven tenant analytics or energy-efficient retrofits are positioned to reshape retail operations. Companies like Catalyst Brands face execution risks unless they successfully integrate digital and physical retail models. J.C. Penney's store sale is more than a bankruptcy restructuring. It's a harbinger of retail real estate's next phase. As anchor tenants evolve and mall valuations shift, investors must embrace a new paradigm, one where flexibility, technology, and diversification outweigh the allure of traditional retail models. The resilience of retail real estate in 2025 lies not in resisting change, but in harnessing it. In a significant transaction, Blackstone Commercial Corporation has acquired 3 industrial properties located northeast of Detroit, Michigan. These properties are situated at 42,050, 42,150, and 42,200 Executive Drive in Harrison Township, Michigan, and total 215,102 square feet. The acquisition was finalized for nearly $16.3 million, equating to approximately $75 per square foot. The seller, Yanfeng Automotive Technology US, which is a global supplier of auto interiors, exteriors, seating, cockpit electronics, and passive safety systems, has agreed to a leaseback arrangement for the entire property. This means Yanfeng will continue to occupy and operate within these buildings despite having sold them. The transaction was completed with a capitalization rate of 9.59%, reflecting favorable terms for this sale and leaseback agreement. This transaction highlights the strategic importance of industrial properties in regions with strong automotive and manufacturing ties. The leaseback arrangement allows Yanfeng to maintain its operational continuity while freeing up capital for other potential investments or operational needs. Drawing parallels to regions like Kitchener-Waterloo, London, and Cambridge in Ontario, we can observe similar trends in industrial real estate. These areas, due to their proximity to major transportation hubs and growing urban populations, are also witnessing increased demand for industrial spaces. This demand is driven by sectors such as automotive, technology, and logistics, mirroring the dynamics seen in the Michigan market. For Canadian investors looking at cross-border opportunities, the resilience and strategic positioning of industrial properties in the U.S. offer valuable insights. The Blackstone acquisition underscores the attractiveness of industrial assets, especially those with established tenants like Yanfeng, which can provide stable income streams through leaseback agreements. This is particularly relevant for investors interested in diversifying their portfolios with stable, income-generating properties. In a notable development in the commercial real estate landscape, the Uptown Tower, an iconic structure in the heart of the city, is set to undergo a multi-million-dollar renovation. This ambitious project aims to reposition the property, enhancing its appeal and functionality to meet modern demands. The renovation will include a comprehensive overhaul of the building's infrastructure, incorporating sustainable design elements and cutting-edge technology to optimize energy efficiency and tenant experience. The renovation plans for Uptown Tower, as reported by Elise Franco, focus on creating a vibrant and dynamic space that caters to a diverse tenant base. The project will upgrade the building's facade, common areas, and amenities, aligning with contemporary trends in commercial real estate that prioritize flexibility and sustainability. This repositioning effort is expected to attract a range of tenants, including businesses seeking innovative office solutions and retailers looking for prime locations in a bustling urban environment. The strategic renovation of Uptown Tower highlights a broader trend in the real estate market, where older properties are being revitalized to compete in an increasingly competitive landscape. By investing in state-of-the-art facilities and sustainable practices, property owners aim to enhance asset value and ensure long-term viability. This approach not only benefits tenants through improved spaces, but also contributes to the overall economic vitality of the surrounding area. For investors and stakeholders in the commercial real estate sector, the Uptown Tower renovation represents a proactive response to evolving market demands. By embracing innovation and sustainability, this project exemplifies how properties can adapt to changing tenant expectations and environmental considerations. As the industry continues to evolve, such initiatives are likely to become more prevalent, driving growth and transformation in urban centers across the globe. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.